In the last 10 years as a CPA, I have saved clients over $500,000 combined on their taxes. So in today's video, I'm going to reveal the three most important principles that I've learned after serving thousands of clients so that you can actually start saving money on your tax bill. Because the truth is, most people massively overcomplicate the process and simply don't know how to use a very simple structure to save tens of thousands of dollars in taxes. In fact, I use a very simple framework that I like to call the measure twice, cut once method. And that's precisely what I'm going to teach you today because it all breaks down into three simple principles. Number one, you want to know what your taxable income is. Number two, you want to calculate the amount of taxes that you actually owe. And number three, you want to implement your tax savings plan. Now, if you want me to come into your business to make sure that you save money on your taxes this year, click the link in the description of this video to apply to work with us. And by the way, our average client, when they first start working with us, they save about $10,000 more than their prior accountant. Just take this client here who before working with us, they were set to owe $43,000 in taxes. But after working with us, they only owed $15,673. Pretty good ROI if you ask me. So again, click the link in the description of this video to see exactly how we can help you and get this exact roadmap. Without further ado, let's jump into today's video. When it comes to saving money on their taxes, most people, and sometimes most accountants, they're kind of like Owen Wilson in this picture. They're just simply winging it, and they're kind of guessing. They're looking on TikTok and thinking, I need to buy a car or I need to buy a rental property, but they actually don't do one of the most simplest things. And we've all learned it from our arts and crafts teachers or wood shop or our parents, especially when you're making stuff, is measure twice and cut once. So what that means is make sure that this thing fits, take the dimensions of what you're going to build first, and then start building it. It is the exact same thing with taxes. I can't tell you the amount of times that I see people or clients, they meet with with accountants and they meet with new prospects or new clients and they immediately want to start loading people up with management companies and all these complicated structures when they haven't even measured their income, which is the first time, and the second time they haven't measured what they would owe in taxes before any of this complicated stuff. Now, I want to break this down a little bit more because I think nobody has really ever looked at a tax return. And I actually think it's very important because most people, they think that taxes, and I know from clients they kind of just think it's like hocus pocus and we're just sifting through the tax code here, when in reality that actually couldn't be further from the truth. So I want to take an example of one of our clients, and obviously we changed our name, but you want to look at your taxes simply as a math equation because at the crux of it, at the foundation of it, your tax return is simply a math equation. Now, when I zoom in on this return here, this has all of your income or has some of your demographic info like your kids, your address, um, name of your spouse, all that stuff. But let's really look at this income section here because it's actually not as complicated as one would think. And you guys are going to see it by the end of this video. I'm going to show you guys a copy of one of our clients' tax plans, and it goes through all of this, measuring once, cutting twice. Or sorry, measuring twice, cutting once. But again, looking at this return here, it simply is just a checklist of all your income, as you see here in this income section. Let's see, that is a little bit too thick there, so we'll use this one. But if we look at this here, it asks for all of your W-2 income, all of your interest, your dividends, distributions, retirement. It really is just a checklist, and you add it all up. So this client here, they had $223,000 of W-2 income. They had $4,000 of interest. They lost some money in the stock market. This big line here, line 8, where it says Schedule 1, that is a combination of all of your business income. So if you own a business, 100%, 50%, you pay taxes on all of the profits of that. And that line there, this line 8, this is a summation of all of your business income, whether you own one business, whether you own 10,000 businesses. All of that goes there. It goes on that one line, and then you come to your total taxable income or total adjusted gross income. So I should say, which is this number here. Then you get a deduction from the IRS. They give you, if you're married, it's $29,200. And again, this is a 2024 tax return, but This all works actually exactly the same. Once the 2025 tax return comes out, it's going to be very, very similar. All the mechanics work the same. Let's not get caught up on which line goes where. It's how we add all this up. The IRS gives us a standard deduction. All of us that it's 14,100. If you're married, you just combine that. This here is a business income deduction. We're not going to worry about that, but it's more so I want you guys to learn this is how the return actually flows. And it really, again, is simply a math equation. After that, you get to what is called your taxable income, which is what I talked about. You want to know what your taxable income first is before you ever meet with an accountant or during or a tax advisor, because they have to know where you're at. Kind of think of it like a map. You have to know where you are. Now, if we scroll down here, the IRS tells you that this is simply your tax that you owe. You get a credit for the amount of kids you have. In 2024, it was $2,000 per kid. That person had 3 kids. That would be $6,000 in credits. The 600, that is basically a daycare credit that they have, child independent tax credit. And then you scroll down to here. This is the total tax that you owe. Now, this number here, this $36,000, that is the amount of money that they withheld on their W-2 or on their combined W-2s. So they owed 33,000, they withheld 36, and then they got a refund of 2,400. As you guys see, this is a big math equation. I think a lot of times people, again, they think it's hocus pocus, the way that you play around with the numbers and you move things around the return. You really can't move things around on a tax return. As you said here, W-2 goes here. The IRS does not let you freestyle it and say, you're kind of an artist. I think we're going to put the W-2 income on line 7. That's not how it works. It literally goes here line by line by line. It is, like I said, it is simply a math equation. Now, to even drive home this point a little bit more, this here is what is called a tax table. Now, again, I do not expect any of you guys after watching this say, you know what, I'm going to do my taxes by hand because I'm watching this great CPA on this video showing me how to do it. No. It's more so to show you guys that it is completely possible, and it's more so, again, how this all works. Now, again, this is what is called a tax table or a tax computation worksheet. This is straight from the IRS's site or straight from the instructions. Now, you just go here and you look at your filing status. This is for anybody who makes over $100,000. You just look at your filing status. If you are single or if you are married, that person was married. And again, just to kind of show you guys, it really is just a big math equation. So we look here, it says, if line 15 is at least 100,000, but not over 200, you basically go to see where you fall. So now, let's go back up to where this client was. And you will see that line 15 is $226,516. So now we just take that number and we put that here, multiply it by 24%. We get that number. Just trust me, this is what the math is. Get out to $54,364. You subtract that number, and then the IRS says that is your tax. And again, this goes on line 16. So now we just go back to line 16, and it's $40,449. Again, let's not worry about calculating what this $42 is. It's a net investment tax. We're not going to really hammer that home. It's more so, again, to see that how you guys can see that this is simply just a math equation. Now, another thing that I want to show you is this here, is that this comes from the tax return. Again, we're not going to go through all 300 pages of this person's tax return. It's more to show you guys kind of where to look. This is what is called your Schedule E, or Schedule E Part 2, page 2. If you guys own water pass-through entities, this will tell you here how many businesses you own. So this person, obviously it's my business. And another thing I wanted to show you guys was that you guys are, when you have a business, it's a little bit different than a personal return. You are taxed on your income minus your expenses or your profit. And as you can see here, you can take a loss, you can take an income, you can take Section 179. It's all these things that you guys have to take. However, when you are a W-2 taxpayer or your W-2 income, it's very hard to offset that because there's nothing on here that says W-2 deductions, right? W-2 losses. That doesn't exist. There are some deductions. There are some deductions like 401k, HSA, child or not dependent care, insurance, things like that. But you're very, very limited. Now, again, this is more so to show you guys what the principles of a tax return are, because I think most people massively overcomplicate this entire thing. And again, I'm going to show you guys an example at the end of this video to where we went through a tax planning situation with our clients following all three of the principles. But now let's jump into those principles. Now, step number one is that you have to know your taxable income. In order to get that, you have to be able to calculate your taxable deductions. Now, again, when we are meeting with clients throughout the year, or new clients too, when we meet with them, we always tell them we have to know what your income is and we have to know what you pay in taxes, because until we know that, anything that we tell you doesn't really matter. The analogy I like to make is, think about it with a car. Is if I have a Honda Civic, and if I called Honda and said, or a mechanic and said, I want to take my car in today because it's making this sound, how much is that going to cost? What does it take to fix? First thing the guy's going to say to you is, I don't know anything you have. I don't even know if you really have a Honda Civic. I don't know what that sounds like because you're probably not describing it right. Let me look under the hood. It's the same thing with your taxes. You have to look under the hood of your car. Now, again, this first step of the measure twice, cut once, step number one, you have to be able to calculate your income. And you want to look at all things. Again, if we look at that return, right, you want to know, what are your most recent pay stubs? How much have you made? Because again, you want to think of this throughout the year, because the tax return, that's more of a checklist for last year. This is more for this year. And you want to look at all of your recent pay stubs. That'll have year-to-date numbers, withholdings, how much you've made, how much you've paid in. We have to know all that because maybe you overpaid and we don't pay anymore. Maybe you've underpaid. We have to know that. The next thing we have to know is we have to know all of your interest income, dividend, investment, capital losses, capital income, or capital gains, capital loss. We have to know all that. You have to have your business profit and loss statements, all of your rental property and loss statements. We have to have all that because we have to know your income. And also, we have to know if you've had any deductions this year. And again, I'm not expecting you guys to memorize this by fact. It's more so that we have to know. You need to calculate, or the first step of this is the measure once one. Now again, did you make any big business, vehicle, or equipment purchases? And anything big, I say over $2,000. Did you purchase any investment properties? Did you buy a rental property? We also want to know, how much have you paid in mortgage, your latest mortgage statement for all personal and business residents? And lastly, we want to know how much you've donated to charity, because all of these are going to make a difference. When we calculate your income, we have to know these things. Now, once we have all of the income and all of the, what I would call above the line deductions you have for your income, now we need to actually know how to calculate your taxes. And again, I want to show the same picture as number two, step number two of measuring twice. Now that we know your income, we have to calculate your taxable income. And you have to take taxable income, and you're going to use the IRS tax tables, or if you have fancy software like me, you'll use your tax software. So again, this goes back. This is the same return that we looked at before. Now we've totaled up all of their income, which is $226,000. Next thing we have to know is, what is your actual tax? And, let me zoom out here. You want to go to your tax table. And again, we went over that. But just to go over it one more time, you want to know what your taxable income is. You take that number here, 226, multiply it by this here, 0.24 or 24%, get 54,000, subtract that, get 40,409. Now, we know without a shadow of a doubt that your tax that you owe is $33,000. You have to figure out how to come up with that money, whether that's through withholdings, whether that's through lowering it with certain things. But we have to know, before we've implemented any strategies, you have to know what your taxable income is. Now we can attack that. Now the next step, or the last step of the measure twice, cut once, is step number three. You want to implement your tax savings strategies. Now, a lot of times you will hear on videos, go out and buy a car, go out and put money into retirement, go out and hire your kids, go out and make your travel tax-free, tax deductible. However, one simple thing that most people don't ever ask is, I like to ask them, where are you? Right? Where are you on the tax savings landscape? Number one is, how much did you owe in taxes, which we know here is $36,000 or $33,000. Now, the next thing that we want to know is, where are you in your life? For example, do you have kids? How old are they? Where do you live? Are you married? Do you want to have a retirement? Can you contribute to an HSA, what's called a health savings account? You have to know where you're at. And I don't mean where you're physically located, but where are you at in your life, right? Where are you? Because if you don't have kids, you can't hire them. If you aren't married, you can't hire your spouse and maybe contribute to their retirement. You can't, if you don't have anything like that, you have to know where you're at. And I know those are very simple things, but I know plenty of people who will buy $30,000 tax plans without really knowing where they are, or without really knowing where they are in their tax journey and where they're at. And then I'm spending $30,000 and like, I didn't need all of this because this doesn't make any sense. So you want to make sure that you know where you're at. And that's why I like to call this the measure twice, cut once. You really want to take your time with this. Not so much that you have to take months and months to do this, but just be very calculated. Now that we have all these three principles down of calculating your income, calculating your taxes, and then implementing your strategies, now we want to look at an actual example from clients that we met with in November. And I want to show you guys how we took all of these three principles of measuring twice, cutting once, and just knowing where all of this stuff is. And I want to show you where they were before and where they are after with some of their certain tax strategies. Now, we're going to scroll down here on the screen a little bit. This here is a copy of our client's tax calculation. Now, again, we don't use a actual tax term like the one that I showed you, but it really is the same thing. And the first thing that we did was we took out is that we do a few calculations. This here was their final one, but I want to show you guys kind of how we take all these things into place. The first thing that we did was we calculated what their income was. We took all of their business income before we even met with them, right? We met with them in I believe it was October of this year, or sorry, in November this year, so we used October numbers. Now, the first thing that we wanted to do was we wanted to look at where all of their business income was. In October, they were set to make $157,000. And again, I have some notes there. We don't need to get in what the nitty gritty notes are, but it's more so that we're taking a very measured shot with what we're doing. So we looked at this return or at their profit and loss, and it told me their business income. Now, if we go down here and we scroll down, the next thing that we did was we looked at all of their pay stubs for their year-to-date numbers. Now, this came, oh, there we go. It came out a little fuzzy. Was again, we wanted to look at where they're at. And again, this was from November. So the first thing we want to do is let's see how much their wages are. Through November, they were paid about, this person was paid about $51,000. And now they were in a non-tax state, Texas, and they withheld $4,911. Now, we obviously know that they are going to make additional money throughout the year because they've got, what, 3 paychecks left. And as you can see here on some of my calculations, I went and looked, hey, they've had wages so far this year of $51,000, and they've probably got 3 checks left. So I took 3 checks times, where is this? 3 checks times whatever their income is, 2,300, and then I simply added it up, and I thought this person for the rest of the year is going to make $58,000. And then the next thing is I wanted to look at their federal withholdings because again, as we saw in our example at the top, is you get to take credit, you get to deduct what you've already paid in federal taxes. So I have to know what they're going to be paid at the end of the year. So again, the same logic here is that I took their federal withholdings, which is, if I zoom up a little bit, was 4,911.56. And I just did it there. So that's all they withheld. And again, I know they have 3 remaining checks. So I multiply what their normal withholdings is, 198.52, and I multiply it by 3, and now I get what they're going to withhold and what they're going to have in taxes. Now again, since this is a married filing joint couple, I have to also factor in what the spouse makes. And again, we do the exact same math here. We take what their total income is, what their total withholdings is, and I do the exact same calculation. And again, you want your accountant to be doing this for you before you do any tax planning. Again, with all of our new tax planning clients, this is the first thing that we do is we look, what is your income right now? Year to date, what is your income and what is it going to be by the end of the year? Because again, we have to know where we're at. So now, once we have all of this income, we have their W-2 income, because again, if we look here at our checklist of things that we have to know, we have all their recent pay stubs. They did not have any interest income, but we have all of their business P&Ls. They did not buy any more rental properties, and you'll see some of the deductions that they had. Now our next step is we have to calculate their tax owed. Now if we go back down to this first one here, this is what they would owe. This is a tax calculation. Again, it's different software, but it's all the same thing. As you guys can see here, you have your wages, interest, dividends, so on and so forth, total income, you have your IRA, all of your other adjustments, you have your itemized deductions. I whited out some of this stuff over here. And you have your total tax, and you have what was withheld. So we know when we first met with them, we said, client one, client two, they're a married couple. If everything keeps going according to plan, come April 2026, and I want to write this down, when your tax return is due, April 2026, you would owe $15,000. Now, again, we just did steps 1 and 2. We measured their income and we measured their taxes. Now, if we go back to this slide here, or this image here, right, we have to know, where are you? Do you have kids? Are you married? Do you want a retirement account? Can you, again, these are plethora of things. You have to know where you're at. Now, I want to go over with this certain client, again, you'll see this arrow here, is that we looked at their profit and loss. And the number one thing I'm looking for first is there anything that they are potentially missing right now? Now, again, I'll go, I didn't put the whole P&L because it was about 4 or 5 pages long, but I want to look for certain things that are missing. And the number one thing that I saw was, I said, hey, do you guys work from home? And they said, yeah, of course we do. I said, well, I don't see a home office deduction. So we basically guesstimated it's probably about $7,000. Now, the second thing that we did was, again, going back to this question of where are you, is, they're married, but they don't have kids yet. So there's nothing they can write off with kids. They can't deduct them, pay them, all that stuff. So we asked them, do you want to have a retirement account? And they said, yes, we do want to be able to put money away into an IRA because they have been newly self-employed for about 18 months and they haven't contributed anything to a retirement account. So what we want to do is they wanted to max out a traditional IRA, which would have been about $7,000 per person. The next thing we asked was, and again, on that deductions list, did you buy anything big assets? And they said, well, not yet, but we need to buy a new vehicle probably sometime in January. I said, great, what's the budget for that? They're like, we're looking at $30,000, and it was going to be a very, very heavy truck. Now, when we looked at this, I thought, okay, we have just found, what is this? 30 plus 14, 44,000, $51,000 in extra deductions that they have. So now, again, with the measure twice, cut once, we want to look at that because we know what their original tax was. Now, we ran a second tax calculation with basically the same numbers, less all of their deductions. So if we look here again, same income, 117,000. Now, what you guys will see is a little bit different is that their original taxable income was going to be about $98,000. However, you'll see this is a little bit lower. This here added in the taxpayer IRAs, the spouse and the husband, for $14,000. And then what we also did was that we subtracted the $7,000 minus the $30,000. So basically $37,000. Again, one for the home office expense that they have, and number two for a big work truck that they're going to purchase before the end of the year. So now we want to look at where do all of those tax savings net us? And ironically enough, it got down to $5,000. So now, without a shadow of a doubt, we know that by them going out and contributing $14,000 to an IRA, buying a truck at the right time, or a vehicle for $30,000, and contributing to an IRA account or to a retirement account, that they will only owe $5,000. Now, again, where I look at this as a math equation is, again, they went from owing $15,000, so now they know And now they know what the cost of those deductions are, because a lot of times we hear, well, just go out and spend money, go out and spend money, go out and do this, go out and do that. And we want to say, wait a minute, hang on. How much does spending this money? Because don't kid yourself. You do have to spend money for tax deductions. You have to fund your retirement account, 14,000. You do have to pay yourself 7,000. Now again, it's a little bit going from one pocket to the other, but same idea here. And if you want to go out and buy a car, whether you finance it or buy it, you still have to pay that money at some point in time. So now we want to look at this and say, all right, well, all of that money that we have spent nets us about $10,000 in savings. Now, what I want to go back to is I want to look at this calculation here, and you guys will kind of see how the math works. Is why I say you want to know what your taxes are. You have to know where you're at. Now, again, I'm going to use a pen here. I'm going to try to write as I'm going to actually, I'm going to try to write this as neat as I can. So you want to know what your total tax is. So here it was 26,138 is your tax. You want to divide that by your total taxable income, which you get from here, is 165,047. So now your tax rate, as I get a calculator out, and I'm going to divide this off the screen, but you guys will have to trust me that this works, is you want to divide that. So you want to take your taxable income, or your tax, like 26,138, divide that by your total taxable income. So their effective tax rate is roughly 15.8%. Now, a rough estimate will tell you that roughly for every dollar that you spend, you're going to save about 15 cents on the dollar. Now, theirs ended up being a little bit higher because it did drop them into a lower tax bracket. But what I want to show you guys here is that basically the way that you can calculate this is, and again, a rough estimate is that for every $1 that you spend, you'll save 15 cents. So again, this particular client, they went out, they spent, I think it was how much did they do? They spent 14K on retirement income. They spent 30K on a car and 7K on on the home office. This will get them to $51,000. If we multiply that by 0.158 for 15%, that roughly gets you to about 8K, and again, roughly 8K in savings. Now, again, this dropped them down a little bit in the tax bracket, so they did get a little bit of a bonus. But the point is that it is not a dollar for dollar reduction, because when you go out and spend on deductions, you want to think of them as like it's not a credit, it's a deduction. So it's basically like a coupon. For every dollar that you spend, you save 15% in taxes. Again, theirs might have been a little bit higher because it did drop them down to another bracket. But again, this is the crux of the argument of this video, is that you need to know exactly where you are, right? And again, I want to so much hammer this home of measuring twice and cutting once. Now, again, what we did there, we measured twice. We calculated their taxable income. We calculated what their tax was. And then we calculated or measured or cut right where they're at, because we have to know where you're at right now before we even give you any advice. And I can tell you, so many people meet with their accountants, especially new accountants, and they don't take these calculations into account. They just hear all the stuff that they're saying and they sign with them. Now, again, I want to go back to this client here. This is a different one with the savings. And we did the exact same thing for them that we went through here. We calculated their income first. We calculated their taxes. And then we took a calculated shot and thought, you know what? If we do all these things, you can save $30,000, or this was $28,000. So again, if you guys want to work with us, make sure you guys click the link in the description of this video, apply to work with us, and we will get you on the tax savings train. I hope to see you guys on the next video. And more importantly, if you need help, I hope to see you on the next call. I'll talk to you guys soon.